What if the world's second largest economy is quietly unraveling, and you don't realize it yet? In this video, we dive deep into what many are calling China's crumbling economic story. We'll peel back the layers, from a booming real estate engine to a debt-laden slump, from sky-high growth to uncertainty that could ripple across the globe. By the end, you'll understand why global markets, supply chains, and even your next smartphone might feel the shockwaves. Stay with me as we uncover how China got here and where it could be headed next. The rise and the dependence. Not long ago, the economic tale of China was one of near mythical growth. For decades, rapid industrialization, booming cities, and relentless construction turned China into the engine of the global economy. A huge part of that fuel came from real estate. Building apartments, skyscrapers, whole new cities from the dust. According to the International Monetary Fund, IMF, real estate had become responsible for as much as 20% of China's economic activity. But this boom came with strings attached. Local governments relied heavily on land sales to fund budgets. Developers borrowed massive amounts, counting on ever-rising home prices and eager buyers. Many families became investors, pouring savings into apartments not to live in, but as long-term investments. By the time the 2020s rolled in, cracks were already forming. Prices had soared far beyond what many ordinary households could afford. Debt levels for developers and local governments were soaring. The turning point: crackdown and collapse. Then came the crackdown. Recognizing the fragility, Beijing in 2020 to 2021 started tightening rules, limiting developers' access to cheap credit, restricting borrowing, and discouraging over-reliance on debt-fueled growth. The result: what had once propelled China forward started to drag it down. Housing starts plunged, down more than 60% compared to pre-pandemic levels. Many buyers, fearing unfinished projects or falling prices, stopped purchasing. Real estate investment, once a mainstay of growth, collapsed. Analysts warned that investment levels could remain 30 to 60% below peak for years. Still, for a while, China seemed to muddle through. Some growth remained. In early 2025, the World Bank reported a 5.4% year-on-year GDP expansion in Q1. But beneath the surface, tensions grew. By mid-2025, the cracks widened. The World Bank revised expectations. Growth would slow to around 4.8% in 2025, with even slower expansion expected in 2026. Major signs started to emerge across the economy. Fixed asset investment, especially in real estate, continued to shrink. Consumption remained soft. Low consumer confidence, weak wage growth, and uncertainty over housing weighed heavily. Manufacturing and exports, once strong, began facing headwinds due to global trade uncertainty. But nothing sent shockwaves as strongly as what happened at one of China's biggest property developers, China Vanke. For years, Vanke was regarded as a stable titan among the safest property developers in China. Yet in 2025, everything changed. In late November, Vanke requested to delay repayment of a 2 billion yuan bond, sparking panic in financial markets. Bonds and shares tumbled, some to record lows, and trading for certain bonds was halted. That single event did more than shake investor confidence. It raised a chilling question. If even the strongest developers can't manage their debt, who can? Credit rating agencies swiftly downgraded Vanke, citing unsustainable financial commitments and deteriorating liquidity. Suddenly, the long-feared contagion didn't seem hypothetical anymore. The crisis had edged from weaker, obscure developers into China's blue-chip elite. When a massive property slump intersects with weak consumer demand, unstable investment, and global uncertainties, the result isn't just a slowdown. It can spiral into structural change. Here's why. The property sector in China had served as a reservoir of household wealth. As prices drop and developer confidence erodes, many families feel poorer and cut back spending. Local governments that relied on land sales face budgetary shortfalls, limiting their ability to invest in infrastructure or social services. High unemployment risk, especially among youth and migrant workers as construction slows and companies freeze hiring. Deflationary pressures. Weaker demand can lead to lower prices, which can further depress investment and consumption. Beyond China, global supply chains from electronics to raw materials, from commodities to manufacturing, feel the pinch. Export-oriented economies suffer when Chinese demand weakens. Financial markets worldwide tremble when a giant like China shows cracks. Here's the central challenge. Can China navigate this structural slowdown without triggering a deeper economic collapse? Answering that requires confronting multiple dilemmas. Debt versus growth. Real estate contributed massively to growth, but at the cost of massive debt. Point 1. Scaling down the sector reduces risk, but also removes a key growth engine. Short-term stimulus versus long-term. Point 2. Reform. Policymakers can pump money into infrastructure or offer subsidies to prop up demand, but that risks creating new bubbles or burdening public debt. Consumer confidence versus. Point 3. Uncertainty. Unless households feel secure that homes will be completed, prices won't crash further. Jobs remain stable, consumption and investment will remain subdued. Global headwinds. Global trade. Point 4. Tensions, slowing demand abroad, and tighter financial conditions worldwide limit how much China can rely on exports to pull it forward. In short, the structural problems are deep. Quick fixes may ease the pain, but they don't solve the root causes. Let's explore 3 possible paths for China's future. In this scenario, the Chinese government manages to steer the transition carefully. Through a mix of targeted stimulus, infrastructure, social housing, rental housing, regulatory reform, protecting home buyers, restructuring bad debts, better banking oversight, and incremental fiscal effort, the economy stabilizes. The property sector shrinks to a sustainable size. Consumer confidence returns gradually. Growth resumes, albeit at a lower, steadier pace, perhaps 3 to 4% annually. This is roughly the path the IMF recommended, a shorter and smoother adjustment by allowing prices to adjust, restructuring non-viable developers, and supporting viable ones while shifting towards more sustainable economic engines. If the authorities fail to manage the transition, if bad debts accumulate, homebuyers lose faith, developers keep defaulting, and local governments face fiscal stress, the slump could stretch over years. Real estate investment stays depressed, consumer demand remains weak, and growth stagnates. China may drift into a long, low-growth environment, maybe 2 to 3% growth for years, higher unemployment, deflationary pressure, and social strains. Economists at Goldman Sachs have warned that the property crisis could get worse before it gets better, projecting home price drops of up to 10% before a bottom is reached, possibly as late as 2027. In the most optimistic scenario, China uses this slowdown as a catalyst for transformation. Authorities shift focus from property and heavy industry towards services, technology, domestic consumption, and innovation. Investment in green energy, high-tech manufacturing, digital infrastructure, and social welfare expands. Banking reforms, better social safety nets, and more transparent markets rebuild confidence. Over time, a more balanced, modern economy emerges, less reliant on real estate, more resilient, more consumer, and innovation-driven. Some signs already point this way. Policy statements about boosting consumption, encouraging affordable and rental housing, and reorienting infrastructure spending. The real turning point may already be upon us. The moment when a heavyweight like Vanke, once considered too big to fail, falters, the narrative shifts. The era of guaranteed growth through bricks and loans may be ending. In that key moment, everything changes. Confidence that homes would appreciate forever is shaken. Investors, both domestic and global, ask, if Vanke can't make it, who can? Local governments lose a major source of revenue. Households postpone buying or investing in property. hurting future demand. That collapse of confidence, more than any statistic, could define whether this is a rough landing or a prolonged descent. China's crumbling economic story isn't about a sudden crash. It's about a slow, structural unraveling of a growth model built on real estate, debt, and infinite demand. The signs are all there: shrinking investment, weak consumer demand, stressed developers, rising defaults, and tremors in financial markets. The fall of one of the biggest developers, Vanke, could be the alarm bell. But this story is far from over, and its ending isn't written yet. It might lead to a painful, drawn-out slump, or it could spark a structural transformation pivot toward a more balanced, sustainable economy, driven by innovation, consumption, and reform. What happens next depends on choices from policymakers, investors, and citizens. And if you enjoyed the video, make sure to like and subscribe, and check out the channel to find more amazing and new videos.